Okay, let's unpack this. We often talk about global politics, international relations in terms of ideology or spheres of influence. But if you really start to peel back the layers, so many of the world's biggest outcomes, alliances, conflicts, these quiet shifts in power, they're driven by something else. They're driven far more by financial dynamics, specifically money, debt, and access to capital. So this deep dive is our shortcut to understanding what's often hidden right in plain sight, the fragile plumbing of global finance. Our mission is to trace the history of international debt, look at how financial crises and bailouts actually work, and then assess the often hidden risks inside the U.S. system right now. And finally, explore what might come next, from gold to, say, decentralized finance.
And we're going to guide you through some great source material, including excerpts from Money, Debt, and the Fragile Future of Global Finance. All of this is informed by, well, a career spent trading emerging markets debt. And it's an asset class that is constantly moving, constantly in crisis, and, constantly providing lessons about what happens when sovereigns live beyond their means.
That's a great place to start. Let's cover the basics for anyone who might be, prepping for a meeting or just trying to get up to speed. When we say emerging markets debt, what are we actually talking about? Why does it matter?
Well, emerging markets debt, or EM debt, has gone through this huge transformation over the last, say, 30 or 40 years. It started as something called LDC, debt less developed country debt, mostly just bank loans that went bad. Today, it's massive. It characterizes almost everything outside of the G7 club of major nations. It's a multi-trillion-dollar asset class. It ranges from very high-grade corporate debt in Seoul all the way down to, defaulted sovereign bonds from places like Venezuela.
And how do these countries actually get the money? How do they raise it?
They issue bonds. They do it both locally in their own currency and, crucially, in hard currency, usually U.S. dollars or euros. These dollar bonds are often called euro bonds. And when a country like, say, Kenya issues a euro bond, they get dollars from international investors, which is great. But they also take on a huge risk. If their local currency falls, it becomes exponentially harder to pay back that dollar-denominated debt.
Right, that structural risk borrowing in a currency you literally cannot print. That's key.
Yeah.
But what's really fascinating here is the origin story. The whole asset class really grew out of failure, right? The Latin America debt crisis of the 80s.
That is absolutely correct. By the late 80s, U.S. money center banks were just completely hung up. They were sitting on all these defaulted Latin American loans, massive liabilities on their balance sheets. It was threatening the stability of the entire U.S. banking system.
And that's where the U.S. Treasury steps in.
Yeah.
This leads to the Brady Plan in the early 90s. It was, a mechanism, a giant financial cleanup operation designed to get this defaulted debt off the bank's books. But the genius of it, the specific part that really made it work, was the collateral.
Yes, the toxic debt was converted into these new tradable Brady bonds, and these bonds were backed with collateral, specifically U.S. Treasury strips. And we really need to pause on that mechanism because it's just so foundational to everything that followed.
So why Treasury strips? What made them the perfect tool?
A zero-coupon Treasury strip is essentially a U.S. government bond with its interest payments stripped off. So it just guarantees a single payment at maturity. It's considered the purest, most risk-free asset in the world. So by backing the principle of these new Brady bonds with U.S. Treasury strips, you effectively transferred the credit risk. It went from the defaulting nation to the U.S. government itself. It basically told investors, look, you might be buying debt from a risky country, but the principal is absolutely safe. It's collateralized by the U.S. And that cleaned up the banks. It created these liquid, tradable securities that a much broader base of investors wanted. And critically, it allowed these countries to borrow again.
So it's good for the banks, good for the countries, and it created a whole new global investor base, a success story of institutionalized debt management. But of course, that new liquidity created the perfect environment for the next set of crises.
That's just the nature of finance, isn't it? New liquidity breeds new debt, and new debt eventually leads to a new crisis.
And you started your career right in the middle of all this new, highly volatile world.
Yeah.
You lived through this series of rolling crises. What was that actually like?
It was constant turbulence. I started in the early 90s, and it was a very steep learning curve. We had the Mexican peso crisis in 94, massive capital flight. Then the Asian financial crisis in 97, which hit the Thai baht, Indonesia, Korea. Countries that everyone thought were structurally sound suddenly looked very, very fragile. Then Russia defaulted in 98, Argentina in 2000. So it wasn't a matter of if a crisis was coming, but really just where it would land next. It definitely grounds your ability to stay, perma-bullish on anything when you see that early on.
And the big lesson from those bailouts, especially the scale of the Mexican one under Robert Robin, was about commitment. It's this idea that you have to go in with a bazooka.
Yes, the mother of all bombs. The lesson is that you need way more financial firepower than the market thinks is necessary. The market isn't rational in a crisis. It runs on confidence. So half measures or even three-quarter measures, they just give you this temporary spike in sentiment. Everyone catches their breath, realizes the actual need is still bigger than the rescue package, and then the panic just accelerates. You have to come back with massive swap lines, mega bailouts, a level of commitment that truly restores stability.
And this is where the International Monetary Fund, the IMF, comes in.
Yeah.
They're sort of the global constant in all this, the backstop, keeping countries afloat, offering emergency loans, but always with strings attached. Austerity programs.
Right. They mandate things like cutting government expenses, removing subsidies, selling off state assets, and often raising interest rates dramatically to stabilize the currency. The idea is to impose financial discipline.
Which raises this really important question that kind of challenges the whole IMF approach. Do these austerity programs actually work?
That's the critical debate, isn't it? Generally, in the short to medium term, the answer is no. Not politically, and often not economically either. The goals of the IMF and the goals of a domestic politician are, diametrically opposed. A politician who implements severe cuts and slows the economy down, well, they're not going to get reelected. Austerity is politically toxic.
But the argument for them is that they impose reform when domestic politicians can't or won't. So is the failure just political, or are the policies themselves flawed?
It's a combination. They fail because they rely on a government to inflict pain on its own people, often seen as taking orders from the West. That's just not sustainable. And the other issue is that all sovereigns, including the U.S., tend to live beyond their means. The emerging markets just run out of money faster because they don't have the U.S.'s special privilege.
And that's the key distinction. We can run these massive deficits because we hold the world's reserve currency. An emerging market faces this sudden dual crisis. Their currency devalues and interest rates just skyrocket.
And if you connect this to the bigger picture, the thread running through every single crisis from the 90s to today is that the IMF and U.S.-aligned institutions are always there at the end, saving the day. It's a massive, implicit feature of American foreign policy.
Which brings us to a huge macro point. Debt decreases sovereignty. If every country is highly indebted, no one is truly free to act only in their own interest. And this dependence, this financial dominance, is really the foundation of the U.S. system.
It is. And our power, the dollar's reserve currency status, is not just rooted in our GDP. Historically, global reserve currencies, the Dutch guilder, the British pound, the U.S. dollar, they all had one thing in common: military dominance. They ruled the seas and secured global trade.
So this is where it gets really interesting because we have to examine the foundation of that dominance.
Well,
In the source material, you identify a moment that signaled a really critical shift away from the trust needed for that status. And that was the seizing of $300 billion in Russian foreign reserves at the start of the Russia-Ukraine conflict.
that event set a deeply, deeply concerning precedent, a scary precedent. For decades, U.S. treasuries were considered the global standard for risk-free assets. The assumption was that if you bought treasuries or if you stored gold in the Fed, that money was politically neutral. It was safe.
But the seizure just shattered that assumption.
Completely. It showed every other major world power, China, India, Saudi Arabia, that money held in U.S. treasuries or gold sitting in the Fed is not safe. Not if your country runs, afoul of the powers that be. It turned the world's supposed risk-free asset into a politically weaponized one.
And the reaction to that was immediate, wasn't it? What did we see happen with capital flows?
We saw an instant pivot. Major central banks, especially India, China, Russia, they started slowing or stopping their purchases of U.S. Treasury debt. And they dramatically increased their accumulation of physical gold. They're actively trying to diversify away from the sovereign risk of holding assets in the West.
So the gold move is definitely tied to that. It's what you call a debasement trade. The idea that the dollar's value will weaken against hard assets. And you note that the common comparison people use, the DXY or dollar index, is flawed. Why is that misleading?
The DXY measures the U.S. dollar against a basket of other major currencies, the euro, yen, pound, and so on. The flaw is that nearly all of those economies are facing the same structural issues we are: excessive debt, high deficits, struggling growth. So when the dollar looks stable against the euro, it doesn't mean the dollar is strong. It often means both are being debased at the same time against real things, like gold. It's the classic cleanest dirty shirt in the pile problem. We only look good because everyone else looks terrible.
That global vulnerability, it forces us to look at the risks closer to home. Turning to the U.S., the steps we took after 2008, they inadvertently created all these new distortions. I mean, let's talk about the GFC aftermath, specifically keeping interest rates at zero for about a decade.
This is a critical point. Keeping rates at zero, even as the stock market tripled, quadrupled over that period, it artificially placed price controls on the price of money.
Hmm.
In a free market capitalist system, the interest rate should reflect risk and demand for capital. By forcing it to zero, the Fed basically destroyed the market's mechanism for signaling risk, which led to all this misallocation of assets.
And the Fed's biggest fear has always been deflation, right? Prices going down, because that's the real killer when you have a huge debt load like we do. If prices fall, the real value of that $37 trillion deficit actually goes up. So what's the U.S. debt strategy now?
The old target was gentle, 2% inflation to slowly inflate away the debt. But given the scale of the deficit now, the new pivot seems to be running it hot, going all gas, no brakes on growth and inflation to try and escape the burden. We're attempting to both grow the economy dramatically and keep inflation high enough to make that debt cheaper over time.
That sounds like an incredible gamble. Why is it so precarious?
Because it requires perfect control over inflation expectations, which is, well, nearly impossible. If expectations slip, you get runaway inflation, borrowing costs spiral, and your debt payments become unsustainable. We've seen this fail badly elsewhere. Look at Turkey under Erdogan. They tried cutting rates into high inflation. It led to a massive currency collapse. The U.S. is attempting this high wire act where the only safety net is belief in the dollar.
Okay, so let's analyze the U.S. stock market, which is where millions of Americans have their 401ks. You mentioned two key risks from that decade of zero rates: concentration and leverage.
The concentration risk is just massive. It used to be the FANGs, now it's the Mag 7. At one point recently, the top 10 S&P 500 companies accounted for something like 42% of the year's gains. When returns are driven by such a small group, the market becomes incredibly fragile. If one or two of those names hits a headwind, the ripple effect is huge.
And then there's the leverage, the gamification, the volume in options trading, especially those zero-day expiry options.
The volume is astounding. It now often exceeds the entire market cap of the Russell 2000 index.
Which is 2,000 small-cap U.S. companies.
I mean, that's not investing. That's short-term gambling. And it creates an insane amount of leverage in the system when you have these highly concentrated bets using extreme leverage on just a few stocks. The potential for rapid systemic reversals is enormous.
And what's more, the underlying real economy seems to conflict with this high-flying stock market narrative. The U.S. is 70% consumer-led, but we have this very distinct K-shaped economy.
Right. The wealthy upper end is doing great, fueling demand for AI and luxury goods. But the lower end of the income spectrum is clearly suffering. We see that in the data. Rising credit card and auto loan defaults, high layoffs in many sectors. So the sustainability of growth that's led almost entirely by the top is, highly questionable if the foundation is cracking.
And finally, let's just touch on the AI boom itself. Building out all these data centers is incredibly capital intensive. These companies are borrowing heavily, using assets that depreciate very quickly, like chips as collateral. What's the risk there?
It's threefold, really. First, the value of that collateral is questionable. A cutting-edge chip today is obsolete in 18 months. Second, this heavy borrowing by the largest tech companies, it crowds out investment in other smaller sectors, which just adds to the concentration problem. And third, we're building this highly leveraged future based on a technological promise that is incredibly costly to realize.
So given all of that, the U.S. valuations, the structural risks, the big question for an investor is, where should capital go?
The ideal trade is always to look for what's cheap, distressed, or out of favor. So given the high valuations here, you really have to look abroad.
Abroad where, specifically?
Foreign markets, particularly in Latin America, are starting to look interesting again. You're seeing new U.S. stabilization efforts, capital is flowing back, and historically, these markets just offer much cheaper price-to-earnings ratios than the U.S. And beyond stocks, real assets are crucial. Productive agricultural real estate is always a good investment. It's the ultimate disaster hedge. Yes, you should still own some gold and silver, but the debasement trade is already well underway, so the biggest moves may have already happened there.
So if the dollar does eventually lose its reserve status, we seem to agree it won't be the euro or the yen. Gold is sort of the stopgap. But what's the next financial frontier, the logical successor? You believe it's crypto and blockchain.
I am unequivocal on this. Blockchain is here, and it is not going away. It represents the next major technological leap for financial services. By creating a permanent, unhackable electronic ledger, this tech can just transform how value is transferred and recorded, removing all kinds of friction and costs.
And for a practical example, just think about how absurd some current processes are. When you buy a house, you pay thousands for title insurance because the system for tracking ownership is so fractured.
Exactly. Blockchain could eliminate title insurance instantly. You register the deed transfer on a permanent public ledger, and the friction, the cost of verifying ownership, it just disappears. And this applies to every corner of finance.
And there's an interesting feedback loop that actually helps the U.S. system now through stablecoins.
That's right. Stablecoins, which are pegged to the US dollar, are usually backed by short-dated US Treasury bills. So as these get used more and more globally, they create a new, natural, and permanent bid for US Treasury debt, which ironically helps our funding requirements right now. And crucially, they also help people in emerging markets access dollars and avoid the risk of their own local currency without using the slow, traditional banking system. If you look back across the last 30 years, the pattern is just undeniable. At the end of every debt crisis, every bubble, every burst, it's the U.S. or a U.S.-aligned institution like the IMF saving the day. That historical role as the ultimate bailer has been the source of our strength.
So what does this all mean for you, the listener? We've traced this trajectory, from internationalizing debt in the 90s to abusing the reserve currency privilege after the GFC to setting dangerous precedents by seizing foreign assets. The current U.S. system is now relying on going all gas, no brakes, pushing for both hypergrowth and inflation, to manage an unsustainable debt load.
And while I do agree that we are still the cleanest dirty shirt in the pile for now, and capital still sees the U.S. as the last resort.
The final thought for you is this. If the thread running through all financial crises is the United States acting as the ultimate bailer, the critical question remains. If the United States were to need a bailout, who bails out the bailer? You should consider what happens when there is no global alternative left to stabilize the system.